Hey, good morning, guys. It is, oh gosh, it's the 9th. It's raining, but it's kind of warm. So I think it's a perfect time to talk about GDP. What do you say? Um, so some of you guys have been you might be going back to this video. Some of you guys might just be starting here and catching up on it. But really what we want to look at is kind of what GDP looks like, okay? Now I'm going to warn you, there are some graphs in this, but they're pretty straightforward and they're pretty easy to follow, okay? So what we want to do is we want to look at what GDP looks like and what the business cycle means, all right? So let's just get into it. So this is kind of a graph of the business cycle, okay? We have GDP on the y-axis and years on the x-axis, okay? So the business cycle shows the rate of growth in GDP, or in other words, it shows the flow in GDP, okay? It's always going to look like this. There's always going to be these ups and downs in it, and we're going to see what those look like in just a second. So looking at this, the upward slope portion, every time. The upward slope portion indicates GDP is growing at an increasing rate, okay? Duh, it's going up. The downward sloping portion, it says it's decreasing, okay? We're going up and then we're coming down, and we're going up again, then we're coming down, all right? So what do these mean? Well, no, we'll skip that part, it doesn't really matter. So let's look at the different portions of it now. What do these peaks and valleys really mean? So what we're going to do, we're going to put our cursor on the expansionary cycle, okay? That's this part right here. When it's increasing, we call it expansionary. And basically what this means is that GDP is increasing. That's a good thing, right? But every up has its down, okay? So before it can come down, we have what's called the boom or the peak cycle. All right. The peak of the cycle is basically it cannot get any higher, and it doesn't get any higher. Right. We see this sort of thing every time we look back at GDP because it's always calculated for the year before. Okay. You can't really calculate GDP in like now times. You always have to look back at the years before. Okay. So we see like that up, and then we see it come back down, and so that contractionary cycle. Okay, the downward sloping one, meaning GDP is decreasing, okay, kind of this downward flow here, right? That means that it's slowing down. GDP is actually decreasing, and this is a natural thing, okay? This happens all the time. Sometimes it's very small, sometimes it's very big. The stock market crash of 2007, that led GDP in the business cycle to a giant contractionary cycle, okay? GDP just plummeted, all right? But all bad things come to an end as well. The lowest point it can get is called the trough, all right? Meaning this little trough-like area here, duh. Some might call it a valley, okay, the peak and the valley. This is the lowest point GDP gets when looking at previous estimates, okay? So it gets to this point, and then it has a turnaround, okay? So here's real growth, okay? This is what we got here. We got 1980 to 2006, okay? And we can see all these peaks and valleys here, right? Peak, valley, peak, valley, peak, okay? Let's see what that is. So what we want to look at is sometimes we want to see like, well, okay, so how do we determine what a recession is, okay? Well, what a recession is, it is 4 consecutive quarters of GDP lessening of GDP, okay? Non-growth in GDP, right? So 4 consecutive quarters, okay? We can see a pretty big recession here, all right? We can see a recession here, okay? So sometimes recessions can be small, sometimes recessions can be very big, right? If we were to keep going on this graph, we would see a giant recession with the stock market crash in 2007. But let's see what goes on here. So real GDP from 80 to 2006. And so there are expansions, there's contractions, peak, booms, troughs, right? You see it all at the points. But what we want to look at are trends in real GDP, like what's actually happening here. So before it gets to what it's going to talk about, I want you guys to just kind of see, I always take a look at the lowest points, okay? Lowest point, next lowest point, next lowest point, next lowest point. And we see we have this sort of upward trend, okay? And that's exactly what's happening here. Okay, looking at the graph and clicking on the right arrow, we're going to see the trend line. There it is, okay? It does look a little horizontal, but it is growing, okay? In those 26 years, GDP has actually grown in the long run, and that's a good thing, okay? And that's how we measure GDP, and that's one of the ways that we measure the wealth and health of an economy, okay? This is saying how much money we pretty much have, okay, as an economy. We looked at that chart yesterday If we look at that per person, every person in America is worth around $49,000. Okay. So notice the trend of real GDP in the long run has been upward sloping. It's much better than a downward sloping trend. There's very few times in American history where there's a downward sloping long run GDP trend. Okay, we have these short runs here, right? Like right here, but for the most part, in 26 years, the past 26 years, it's been pretty good. Okay, so real GDP in the 3% range is considered to be a rate of growth. Okay, that doesn't cause too much added pressure on the price level, and we'll get to price level and inflation and all that. Okay, so we can see that it's grown from about almost 2.5%. Just to above 3.5%. So that's about 1% growth. Okay, so that's what it means in the 3% range. Okay, we don't want GDP to grow too fast. That's basically what it's saying there. So we're going to stop there. We're not going to talk about GDP in current and constant dollars. You're going to see that in other ways. But I hope this was a little enlightening. This is just what GDP looks like. Okay, hope you guys have a great day, and we'll see you later.